3 limited companies. Whose question was that? So your question was,
I've currently got a limited company.
Yep.
I'm in the middle of pivoting and splitting out, in effect, 3 different revenue streams that are in very different areas. One's property.
So this first company does what?
We're web development and consultancy for the web.
Okay, yep.
Second company is going to be business coaching and mentoring. And third is going to be property rental.
Yep. And your question is?
Currently, web companies paid for all the trainings and things like that I'm going through.
For this stuff?
Yep, because...
okay, can our friend over here claim from the web company costs for his coaching and property business?
No.
Why not?
Not related.
That's why I'm wanting to split it out.
Yeah. And which test does it not meet? Shalina. Wholly and?
Necessary.
Exclusively. You might have a problem.
Yeah,
okay.
That's why I'm splitting them out.
Perfect, yeah, so you just need to move them there.
So I, in effect, transfer the costs from, say, the web one to the property one, property-based stuff. It's not a loan from one to the other, is it?
No. So going forward, have the invoices made in these companies if you've already formed the companies. It just keeps it simple, rather than doing a cross charge. If you move money from here to here, by the way, then it's going to be a loan. Yeah? So in which case, what you might be better off doing, and this has tax consequences with the new tax changes coming in next year, is you have a holding company, and then you've got 1, 2, 3.
Yeah, my accountant said don't do that because that's going to become a problem in about 10 years' time when they decide it was a bad idea and I end up like Jimmy Carr. But my accountant is the kind that I need to change from because she decided that I was going to be sent to jail for something like a penny accounting error, so...
Anne, do you have a view on that?
Change accountants is mine.
I think she was the same.
Yeah, no, I
No, I mean, I can't think of anyone who would actually imagine a penny
No,
or a
I
tiny
personally
amount
agree,
was serious.
this is what my accountant tells me, which is why I'm changing.
Yeah. So the challenge you've got with the holding company structure, without going into too much detail from a tax point of view, is many years ago when Gordon Brown was Chancellor, I don't know why I'm pointing at you, Anne, by the way, but I am.
So you look nothing like Gordon Brown.
Same level of astuteness, by the way.
I wouldn't sell gold the way he did.
He was just following instructions.
True.
So back in those days, what you had something called marginal relief. So you worked out what your tax was, and based on how much profit you make, you'd pay a different rate of tax, which is exactly what Rishi's done in a roundabout way. So if you have one company that's making less than £50,000 profit, you're going to pay 19% tax after next March. If you've got 2 companies in a holding company structure and your profit's over £50,000, you'll have to pay more tax collectively because your profit's over a certain threshold. So the challenge for you will be having a holding company, you may have to pay more tax. But there's lots of benefits for having a holding company structure, which hopefully will outweigh the extra tax you may have to pay. Okay? And if you think you're not going to make £50,000 profit, okay, between the 3 companies over the next 2 or 3 years, then it's probably worth doing this anyhow. If you think you are going to make, like, let's say 50 grand each, then you work out the numbers and think, is it worth paying the extra tax to have this structure? And I can't answer that question for you without knowing the numbers.
of course.
Okay? Happy with that, or will something additional? Any question on that? Yes, sir.
It's not related to that. Just going to ask if you have time.
Are you trying to take me on a different path, are you?
Yeah, different question. If you have time to write it down, it's we're trying to start selling in Europe, and we're still not sure how VAT regulations work with Europe now. Just if you have time.
Complicated.
Yes.
Yeah. If we get time to do it, we will have a look at it.
Yeah.
So you're happy? Yep. Done. SPV to trading company. Whose question was that? That was your question. So your question was, you've got money in a company, and then you want to pass money over to another company.
Yes.
Yeah.
So
Like
the,
this.
The trading company has got operating costs, which is building up.
Yep.
And then I have an SPV which just owns, for example, a property, then flips it and
Yep.
makes a profit.
Yes.
I need to fund the trading company.
Yes.
So I'm wondering how can it be like a management fee or something to get the money from the SPV to the trading company? What's the best way to fund the trading company?
You can loan it. Number one.
Right.
Number two, you can charge a management fee. But bear in mind that you might get to a stage where with the other income in this business, you might go above the VAT threshold.
Yep.
And the property company, if it's a buy-to-let, can't reclaim VAT, so you'll end up paying an extra 20%, which you're going to lose out on. Okay? Or you can have this structure here, where company 2 here moves money up into the holding company as a tax-free dividend and moves it down here, okay, and the funds end up here. This is nice and clean. The challenge you've got is if this is an SPV which holds property, that's an investment business, this is a trading business, and you don't want to mix the two. So I think in your situation, depending on what you're looking to do, I would maybe start off by loaning money from company 2 to company 1. Or have maybe a small management fee in view of the VAT threshold and the rest loan.
Thank you.
Which is kind of a blanket answer without knowing your
Thank you.
specific information. Any questions on that from anybody else, by the way? No? Okay. 10-year-old son.
Just one quick question. You say bringing funds back from the holding company down to the trading company.
Yes.
How would you do that? Would that, because surely that would be a management fee as well, wouldn't
No, you just transfer the funds.
it? Just transfer it down.
Yeah. Because
Okay.
the holding company is a shareholder of those 3 companies.
So it's shareholder funding.
That's right. Yeah. And then you can just repay it back at some point in the future.
Yeah. Okay.
10-year-old son. Whose question was that? So you have a 10-year-old son and you're thinking of adding him to your company.
Yeah, and also how do I add my wife for best practice?
Okay. Do we have a mic, Ramsan or Kiran? So at the moment you have a company and you're a 100% shareholder?
At the moment, yes, but I'm restructuring it.
Okay. And does the company own any assets?
3 properties at the moment, which just completed 2 months ago.
3 properties? And how long have you had them for?
3 months ago I completed them.
On all 3?
Yeah.
Okay. The challenge is you can add your wife and there's no capital gains tax liability for you, but there's something called the settlements legislation which you have to be careful of, which basically came in around about 2008, which stops a husband or a wife transferring their shares to the other partner or spouse to gain a tax advantage. But because this is quite recent, I think you'll be okay anyway. So you can give, say, 50% of the shares to your wife. Do you have a mortgage on these properties?
On 2 of them, yes.
Okay, so you're going to have to speak to your lender to make sure they're okay with you changing the ownership. I don't think they're going to be okay, but that's a conversation you need to have. If you add your son, you can add him on, but you can give him a very small shareholding percentage. Otherwise, they'll be interested in, if he goes over 20%, they can ask you a lot of questions. So I'd give him maybe 5%, but you can give him, I think you pointed towards this, you give him alphabet shares. So in this particular case, just give him Class A shares, and you can give him 1 Class A share or 100 Class A shares, and give him no voting rights. Okay? So then he doesn't control the company in any shape, way, form, act or manner. and you can give him some income at some point in the future. You can also, and this is going to get really complicated now, and so now, who asked the question about IHT? That was you, okay. And I think it was you, David. Okay, so we had two people who wanted to know about IHT and trusts. So if you do this, what you can do is you can freeze the value of the existing shares as the value it is today, and then assign all the future growth to the new shares, which is called, so this will be called freeze the shares, and these will be called growth shares. So all the future value goes to the growth shares, and then at some point in the future, your IHT is reduced because the capital value is passed over to your son. Now that's going to cause you issues with trying to borrow money from the bank, but you can't have everything in life, so you need to kind of balance that out.
Yeah. What my accountant suggested is to give my wife 15-20%, so
yeah.
she's not doesn't have to sign all the documents. I'm gonna be, and he said it wouldn't really affect anything if she's got alphabetical shares, and we can. Does
yeah.
this? What is the difference giving her 50% and 15-20%?
Yes. So if you own more than 25%, you have certain rights over a company. I think even if your wife has 20%, a bank will still be interested in her financial standing and situation. So they still ask you questions, but when you fill out the application, they want her personal details, her income, her expenditure, all that kind of stuff. So I think even if she owns 15%, some lenders will still ask questions. But she has less power and less rights.
Okay.
That's the difference. Yeah? Anything else on that?
No, but in terms of dividends, she can draw in, even more dividends if she needs to, if she's got alphabetical shares.
If she's got the same shares as you, and you own 50% each, then if you take a £10,000 dividend, she must take a £10,000 dividend. Okay, same class. Different class of shares, like your son's got A class, and your wife's got B class. As long as she owns 100% of the B class shares, she can take a different dividend, it's fine. Because then you're assigning a dividend to a class of share, and if only one person owns that class, then only they get the dividend.
Right.
Okay?
Is there an age limit on who you can put on the business?
There isn't per se, but if you have a child, then you would hold those shares for them on trust.
But it doesn't matter what age they are?
No, but under 18, then you hold them on trust for them, so it'll be shown as you're their guardian and you're holding the shares for them. Yeah, but it does create complications with the bank and that type of stuff. Okay, and they can't be a director until. Yeah, that's right. You got it. Happy with that? Okay. That's that done. SPV. Okay. Coaching property. Was that your question?
No, someone else asked very similar.
Who's that? Oh, David. We're back to you again.
Hello.
Hi.
Hi. Yeah, so this is
You've been very quiet, haven't you?
Yeah. I like to keep it low profile. Yeah, so... Oh, hello. Thanks very much. Yeah, so this is about how best to structure a business if you're going to do some coaching and do that just as a coach. And then also you're going to invest in companies. So if you're investing in businesses with a mixture of loan notes and equity for your investment, then that would be another kind of revenue stream. And then you're also investing in property.
Okay, so if you're investing, are those funds in your personal bank account or are they in your business bank account?
In the business bank account.
And is that a sole trader, partnership, LLP, or a limited company?
So it's a limited company, but there's also the option to invest as a private individual as well.
Okay, because and have you made a capital gain recently in the last couple of years by selling off a business?
Yes.
Okay, so without going into too much detail, you want to look at the enterprise investment scheme in terms of making investments. Are you aware of this?
Yes.
Okay, good. Above and beyond this, I would also look at something called investors relief. Are you aware of this?
Yes, it's £1 million, isn't it? Is that right?
No, you're talking about entrepreneurs relief, which used to be £10 million. Now it's £1 million, and it's called business asset disposal relief. This is something different. So
So no, I'm not aware of that.
This very simply, David. Okay, enables you to invest in a company on day one, not later on. So when the company is formed, okay, and if you invest in day one and you keep your funds in there for 3 years, when the company buys you out or whoever buys you out, okay, you only pay 10% tax on the first £10 million. So it's like entrepreneurs relief in a different guise, and the rules are not as strict, and the lifetime limit is still 10 million and not a million. But that's only if you invest as an individual, not through a company.
Okay.
Okay, so I would do that for your investment.
Is that per company or per individual?
Per individual. Per individual.
So-
Would that be cumulative across different companies? Or?
It's accumulative over your lifetime. So you can earn £10 million by claiming investors' relief, okay, through your lifetime. So when you get to 10 million, then you stop, then you just pay normal rates of capital gains tax.
So if you invest,
We'll come over here and then I'll come to you, David.
What if you're investing into an existing established business?
No, you have to subscribe on the shares on day one.
Right, but there's no other relief if you invest later on in a business?
No.
Right.
Other than obviously, if it's an EIS qualifying company and you've made a capital gain, you leave your money there for 5 years, then you don't pay the capital gain, depending on how much of that you invest in the company, and there's no income tax to pay on any income you get. And when you sell those shares after 5 years, there's no further capital gains tax to pay. But that's only if you have an existing capital gains tax bill. David.
so day one, so if you create a new company when you invest in it, because new investors are coming in, then that counts as day one.
That's right, yeah. So when the company is formed.
Yeah, okay.
Yeah. So I would go with this particular structure here for your coaching business. For the property, are you talking investment buy-to-let or are you talking about trading?
Investment buy-to-let, yeah.
Yeah. In which case, have this as a standalone. Have your coaching company as a standalone. You don't need this particular structure, okay? And then invest in shares if you can through your own name, so you can claim investors' relief, unless you're investing in an EIS company because you're looking to mitigate a capital gains tax bill.
Yeah, okay. And if you're going to invest in a company like I described, and part of it is in equity, but part of it is in loan notes.
Yeah.
So obviously you pay a higher rate of tax on interest than you do on the capital gain on the equity.
Yeah.
So are you better off splitting the money that goes into the company? So the loan notes goes via company.
That's right. Yeah.
Fine.
Yeah,
Okay.
you got it. Happy with that?
Yeah. Thank you.
Any question on that? No? Okay. So that's that done. Thanks for watching, and I hope you enjoyed this video. If you have, by the way, make sure you click like, subscribe and post a comment because that tells me that you're engaging and you're finding the content useful. And if you like this video, make sure you check out this video here because it's the next stage in terms of your learning and development.